welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As we get started, let's just do a quick systems check. If you would, type OK in the chat box if you're hearing me clearly and seeing my screen all right. Okay, looks like we're up and running fine. If anyone has any issues as we go along, feel free to let me know. As always, keep in mind that there's risk with each trade that you take. Obviously, you want to manage risk in a way that makes sense for you. And we have some nice tools to make that easier in our web trader and AvaTrade Go mobile app. So we'll go through some of that as we work through some strategies today with the fundamental news. And also keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Real quick, for anyone who's new to things, what is fundamental analysis? Basically, it's looking at the news, different types of news. Some news is coming from an economic calendar with regular economic events. Other types of news could be headlines that are unexpected, that you don't really have the ability to know what it'll be about or when it will come, but nonetheless still affects the movement of different instruments. And so fundamental analysis is looking at these different types of news and how they might affect the movement of the instruments that you're trading on, and trying to kind of read the tea leaves, so to speak, to see which way the wind might be blowing for different instruments that you're looking to trade on. And some examples in the past have been the global pandemic as an extraordinary type of headline, the different wars that break out at times unexpectedly can affect different instruments, different assets on the market. Those are types of extraordinary economic events, and we'll look at some regular economic events today on the economic calendar and take a look at how they've affected movements in the past and try and anticipate what might they do as those announcements come in today, tomorrow, with the current movements, and try and give yourself an advantage with trying to predict which way, statistically speaking, you think it might move compared to the statistics of the past. And so as we go along, if you have any questions, if you want to give any input, feel free to do so with the chat box at any time. Now, starting from our main website, we can log into the web trader in the upper right corner here. Our web trader has a lot of useful tools that we're about to use, some of them for fundamental analysis and technical analysis that you don't find directly in the MetaTrader platforms, but you can trade on your MetaTrader accounts from our web trader with those advanced functionalities. And the same with our AvaTrade Go mobile app, which you can find in your app store for your mobile device to use the same tools that we're about to use in the web trader. So if we log in here in the upper right corner, we'll be in the web trader. And I think a good place to start would be the economic calendar. And so it's not your average economic calendar. If we go to the discovery section here, we see a number of tools that you can use. The economic calendar being one of them. And so as the economic calendar loads, you'll see you have the ability to filter which countries, which days of the week, which types of events, high importance, medium, low, etc., that you want to view. So you set those for the settings that you prefer. In general, we try to focus on the higher level announcements, the ones that seem to have a higher importance in terms of movements on the charts, and for the countries that you think you can find the best movements for. And typically those are the larger economies around the world, the G7 countries, some others with announcements that tend to move more on the charts. Now, if we look at today's date, we need to switch months here. February, today's the 1st. And so we see a number of announcements already came in, many of them high-level announcements. If we scroll down, we'll get to where we're not looking at announcements that already came in. Let me make sure we're on the right. We have a date range, 26th through the, let's get to the proper month here. There we are, February 1st. Okay, so the announcements that already came in, and then this red line tells us that we've gone forward in time when we're below it, and these announcements have not come in yet. So, for example, there's an interest rate decision coming from the Bank of England not too long from now, okay, this afternoon. And so in less than an hour, there'll be a rate decision. Now, you can see the last rate decision held or had the rate at 5.25%, and the last time that there was a rate decision, it held at 5.25%. And actually, this is the expected column for the current announcement, and so they're expecting it to hold at 5.25 again, and we'll see in this column when the decision comes in, the actual rate decision for today. Okay, so the last announcement was at 5.25. The expectation is that it will hold at 5.25. This is the prediction column here, the expected column, and then when the time comes, you'll see the actual decision pop in there. And so at the same time, then there will be the meeting minutes released. So to give kind of an annotation of what they were thinking. And many times that also causes movement as folks dig into those minutes. And then we have a number of other announcements coming after that. So let's say you want to look at the past statistics for this rate decision. How much has it moved different pairings with the Great Britain pound as the rate decision came in? And so we can use these tools, for example, the volatility tool. We can look at any pairing with the GBP that's listed here. We can look at different time frames after those past announcements to see how much did the chart move and in what direction. And then we can qualify the result of the rate decision. Did it come in as expected, above expectation, or did it match the forecast? And typically, the rate decisions match the forecast most of the time. If we look for, did any come in higher than predicted? Once it did. Did any come in below expectation? Once. But if we look, the majority of the time, they match the forecast. You can see by far there's the most data points there. So we can be ready for any occurrence. But if we're studying the probabilities here, it's most likely that this rate decision will come in at expectation. And if it does, we see that the movement has shown that it might go up half the time or it might go down half the time. So statistically speaking, it's hard to trade on this announcement because the predictability looking at the past movements is not very good in the 4 hours after the announcement. And so this particular announcement, the data shows me that maybe I'm not so interested to trade on the results of this interest rate coming in, because most of the time it comes in as expected. And when that happens, it's anyone's guess. Is it going to go up or down? It's 50-50 on those movements. Yes, the movements are large. Over 95 pip average range movement in those 4 hours after the rate decision comes in. But the movement in terms of predictability is very low. It's a 50-50 situation. So this is one where as I look at the statistics, I don't see a big predictability in how I would trade one direction or another. Okay, so then we move on to the next announcements. And it doesn't mean you can't trade on the announcement, but you'd use some other strategy. Okay, and but this economic calendar strategy using the past data, not a strong one for that announcement in terms of statistical probability creating an advantage for you one way or another. Now, if we go down to jobless claims, initial jobless claims out of the US, that's later today, we can take a look and see what has happened in the past with that. And we can pick different USD pairings, Euro USD, etc. We'll leave it on Euro USD 4 hours after the events and see, in general, this event, regardless of how the results came in, overall, 2/3 of the time, the USD strengthens when the jobless claims come in. So maybe it's a fear response. The USD tends to strengthen with fear on the markets. There's been a lot of focus on the US economy and how strong the job numbers have been or not in the US. And so it's possible that regardless of the results, you might see a strengthening of the USD, which is what this shows surrounding this event. If we put all the events. Now, we could qualify that. We can say, well, what if they come in above forecast? Now we see a larger probability. If these numbers come in better, or I'm sorry, higher than expected, which is actually worse than expected, right? Initial jobless claims, meaning if this is higher, there are more people claiming jobless claims, which is typically bad news for a country. That actually has strengthened the USD 3 out of the last 4 times in the 4 hours following that type of result. So we can see statistically there's an advantage from the past that had you sold when the jobless claims numbers came in above forecast, 3 out of 4 times there was a significant drop. And look at the consistency of this drop. They're almost all 3 the same, all 3 times, the ones that dropped, and it's right around 44 pips or so drop. And the one that went up very small, less than 10 pips, okay? So if you'd have sold on all 4 of these, very small loss in the 4 hours after on the one that didn't go the right way, and much larger profitability on the 3 that did go down. So this is one that I might wait and see if these numbers come in above forecast. I might see in the first 5 minutes that the expected movement is less than 10 pips. We see that here, 10 pip range movement in the first 5 minutes after the past announcements. So if that holds and I'm able to get my trade off with less than 10 pip movement, I know in the past it shows 3 out of 4 times it went down over 40 pips in the next 4 hours after that, with the results coming in if they come in above forecast. And the one that went the wrong way, look in the first 5 minutes, it was up 14 pips. So even if I'd have sold on the one that was up after 4 hours, I actually still could have won, because in the first 5 minutes, it was up 14 pips. And after 4 hours, they all were down from that point. So 100% of it dropped. If you got your trade in that first 5 minutes, they all dropped over the next 4 hours. 3 of them dropped nearly 40 or 50 pips. And this one went down from 15 pips to only 8 pips up. Okay, so you see the trend here with those results, it's clear. Now, what about the opposite? If they come in below forecast, maybe it also drops. We'll see. It does, but less consistently, right? Now, all of a sudden, it's 63%, not 75%, if it came in below forecast. And the drops are less consistent. You see very small drop on this one, very small on this one, a much larger rise in the wrong direction on this one. So this one tells me I'm not interested in trading on it necessarily, statistically, from the convincing or not convincing me with the statistics. But if it's above forecast, I'm more interested. Okay, so I can go into this announcement already knowing only if it comes in this way will I trade, and I know what direction I'll trade, and I know the general entry point I'd like to have with maybe less than 10 pips movement from the time the numbers came in, or movement upward if it's moving more than 10 pips, if I'm indeed wanting to sell. If it comes in the way that shows statistically in the past, I would have been successful selling. And I know my take profit I'm probably going to put within a 50 pip range, because in those 4 hours after, it shows those ones that did dropped about 44, 45 pips, something like that. Okay, and my stop loss looks like it wouldn't need to be up more than 10 pips or so based on those range movements of how far did they go the wrong way before they went the right way in those first 5 minutes. So a nice trading plan based on past statistics, and it's qualified that only if these come in above expectation, that's what seemed to trigger a stronger response of the USD strengthening. And that might not make sense logically in your brain. Why would bad news cause the USD to go stronger? And the answer could be, a lot of times the USD is a safe haven when there are fears of recession, that sort of thing. If there are global economic fears, the USD many times can strengthen as a safe haven currency, even if the news itself you think should work against USD itself strengthening. But this is where you don't have to play that mental game of trying to figure out why and guessing in your brain. The whole point of this set of tools is to help you make your decision more robotically based on data rather than based on a hunch, okay? And so that's one option that I think looks somewhat strong today to maybe monitor compared to the rate decision that the data looks 50-50 surrounding that in terms of if this comes in as expected. And if it comes in not as suspected, if it comes in higher, like 5.5 or lower at 5, the general trend is if an interest rate is raised more than expected, the currency tends to strengthen. And if an interest rate is lowered more than expected, a currency tends to weaken. But the fact is, it's very rare that it comes in different than the expectation, but it could. You could be ready for that. And I think that's the only spot where I might choose to trade on this one, is if it came in above or below expectation. And then I would react in the manner maybe that I just alluded to. Okay. Any questions so far on how to use this tool or anything that we discussed on it? I'll pause for a moment. Okay, if I see any questions pop up, I'll try to address them as I see them. For now, I don't see any questions. So maybe we'll look, into tomorrow as well. Tomorrow's the non-farm payroll announcement out of the U.S., which is a huge announcement. It's many consider the biggest announcement each month out of the U.S. anyways, in terms of significance in causing movement on the charts and in terms of having positive or negative economic outlook in general out of the U.S. And so these initial jobless claims are kind of a prelude to the actual NFP numbers that come in tomorrow. And so we can look at that announcement too and see what kind of movements have surrounded the non-farm payroll announcement and the other announcements that come in at the same time with that each month out of the US. And by the way, you could look at the movements around the Lagarde's speech here too, out of the European Central Bank. The reason I'm not going to look at that now is there are no numbers that come in. It's a speech. And so you really have to pay attention to what he's saying as to what direction you think it will move. So I tend to avoid trying to look at speeches and with this type of strategy and looking more at actual numbers that come in, okay? So let's go to tomorrow and look at this non-farm payroll. And there are other announcements tomorrow. You wouldn't have to just look at the non-farm payrolls, but for time's sake, we'll skip down to the non-farm payroll numbers. So here's that announcement, non-farm payrolls. You see the expected is a drop in hiring. Okay, so that's important too, to kind of read into your thinking. Is the expectation positive or negative? And the expectation here is negative, that there will be less job growth out of the US than the prior numbers. A drop below 200,000 really is a signal that there's an expectation of a slowdown in hiring and a slowdown of the economy then in the US. Now, just yesterday, they decided not to lower the interest rates yet in the US, and that created some fear. The markets pulled down, okay? The hope is from many investors that the US will start to lower the interest rates back down, making it cheaper to grow businesses and to get loans and to buy houses because the interest rates were raised to try and bring down inflation, but that also runs the risk of hurting the economy. And so, from a market standpoint, not necessarily from an inflationary standpoint, but from a market standpoint, there's a lot of hope that they'll start to lower interest rates, or at least talk about lowering interest rates soon. And yesterday it was the opposite. They did not lower interest rates in the US. They kept it the same after all the increases that they put in over the last year plus. They did not lower the interest rate, and they in fact talked about being cautious about lowering interest rates anytime soon because they said inflation and the economy are still strong, are still holding higher than they expected. And so that created some fear. There was a sell-off in general on the markets, and the USD in general strengthened because of that. Now coming into the non-farm payrolls with that as a backdrop just from yesterday, already fearful about interest rate decreases not coming, what do you think might happen if these job numbers come in better than expected? When normally that would be good news and cause the market to cheer, that could create even more fear that, hey, they're not going to decrease interest rates if the jobs numbers come in so strong. So because strong job growth would allude to the fact that, wow, inflation might still stick around. If there's strong job growth, you think, well, then there could be strong purchasing out there, which could keep the prices up. And so they might feel the need to keep the rates higher longer if these jobs numbers come in better than expected. That's the thinking going into it. Now let's look at what the data tells us, because the thinking is one thing, but the actual movements can be another. So that's the power of this tool, is to go in and maybe try and get rid of your preconceived conceptions of what we just talked about, and go in and see, does the data match that? And how would I trade if I was trading on the data alone? At least in the first 4 hours anyways, right? So perhaps the first 4 hours moves the opposite way of your logic, but after the first 4 hours, if that's the case, then maybe you trade in the direction of your logic, right? If I think better than expected jobs should cause the USD to strengthen, but in the 4 hours after it weakens, then I can wait 4 hours and then trade in the direction I expect it to go in the bigger picture, okay? So the data can be used for placing trades within those first 4 hours in the direction that the data shows, and also for being patient to wait to place trades if it's maybe going to be in the opposite direction of the data, okay? So let's take a look, non-farm payroll. We'll leave it on Euro USD as a pairing, and 4 hours after the event. If this indeed comes in above forecast, what has been the effect? You see it's 50-50 in the first 4 hours. Okay, I can understand why. And the answer would be, this is a huge announcement and there's so much volatility that it's hard for it to maintain one direction for more than a few minutes in one direction and back the other. With the non-farm payroll announcement, what you get, the volatility is so high, you get near 100 pip range movement in a short period of time. That's what it tells you here. That's double, almost double what the movement was on the other announcement we just analyzed. In 4 hours, it was more like 40 pips, 45 pips. Here we're going almost 100 pips, 91 pips in a short period of time. And the predictability on this announcement we see is 50-50. Half the time up, half the time down if it comes in above forecast. Okay, what if it comes in below forecast? There's the predictability, okay? Below forecast, why is that more predictable? Because number one, it calms fears. If it's below forecast, the market says, maybe rate decreases are coming. And so the fear response weakens the USD because there's less fear. The USD naturally weakens when there's less fear. And it's being viewed as positive because, hey, there might be interest rate decreases more likely now if these came in below forecast. And so you have a double effect of weakening USD because there's less fear, and weakening USD because maybe it's more likely to have interest rate decreases. And so no wonder that if this comes in below forecast, there's a strong probability it could rise based on the past statistics. Whereas if it's above forecast, it's all over the place, up and down, half the time up, half the time down, because there are factors working against each other. Because above forecast is good economic news, which could be positive, but it's also bad news for lowering interest rates if the data was better than expected. And so you get half the time cheering and half the time fear. Okay, so it makes sense that if this comes in above forecast, you're going to get a lot of choppy movement, half up, half down. If it comes in below forecast, the statistics are pretty clear. The euro is going to strengthen potentially against the USD based on the past data. And the one time that the euro did not climb, look how little it dropped. Okay, so again, I would qualify on this announcement, which way am I interested in trading? Only if these come in below forecast, then I'm likely interested to make a move in the direction of these statistics. If in the first 5 minutes I can get in before it goes anywhere near this 73 pip range upward. Okay, so if in the first 5 minutes it's down, we see this one went down, then the statistics tell me that's a good move to get in now, because in the past, the potential is 75% of the time it comes rushing back up. And even the time that it ended up down, it went back up. Most of that drop disappeared. You would have even profited on that one that after 4 hours was down a little. And the other three, when they went up, were up an average range less than 30 pips in the first 5 minutes. But after 4 hours, they were up nearly 85, 90 pips on average. Okay, so it wasn't too late after that first 5 minutes to make the move, is the point, based on these past statistics. Okay, I see a question has popped up. Let me take a minute to take a look. Okay, so Valerie, this tool that we're looking at only allows currency pairings to pull up the past data. We will look at gold, since you requested, and we'll talk about the non-farm payroll and how you could have a strategy on gold, but we can't look at it on this tool with gold. This is only for currency pairings. But thank you for requesting gold. We'll take a look at that. Okay, Mike, yes, you can switch the instruments here. So I can pick anything involving the currency, any pairing involving the currency for the country that the announcement is for. So here it's a USD non-farm payroll, so I can pick from these USD pairings to analyze in the tool. Doesn't have to just be Euro USD. And I would suggest you take the time to go through different pairings, because you might find GBP USD has a different probability percentage from the past than Euro USD. Typically what I see is Euro USD is the most stable with the percentages, but moves a little less than, say, GBP USD. You might not have it as high of a percent probability. You'd see more choppiness, but larger movement with something like GBP USD or USD JPY. They tend to be more volatile, but less predictive. But you can analyze the pairings and see which ones fit the strategy you want to use. Okay, maybe you want lower predictability but larger movements. That's okay too. Then you might switch, instead of Euro USD, like I said, to GBP USD or USD JPY. But as you analyze, like I'll just show you real quick. On 4 hours, around 73 pip range movement with Euro USD. If I go GBP USD, 86 range movement. Okay, it's the same probability, by the way, 75%. Okay. So this one looks just as convincing with a larger range movement than the Euro USD, which instead of being 87 pips almost, it's 73 pip range movement. But it does look more stable. All three of these were almost exactly the same on Euro USD. And on GBP USD, you see these two were lower and this one was much higher. So less consistency, but larger range movement with some pairings compared to others. So very good question. Yeah, Mike, only currency pairings. That's right. Okay, let's go ahead then to a different style of strategy. I think you get the idea on this. And my plan with this tool is on the weekend, Saturday, Sunday, I take the time to plan for the week, which announcements I can be available to act on and see the results come in, and also which ones have the best statistical chance and in which direction. And so I go into the week with maybe 7, 8, 10 different announcement spots that I'm most interested in. And I know in advance, only if it comes in this way, I'll trade in that direction. Some of them, they're both directions I'm interested. They show good statistics regardless of how they come in, but in opposite directions. Others, like this non-farm payroll, I'm only interested if it comes in below expectation, because that shows a consistency of direction movement, where if it comes in above expectation, the past shows it's anyone's guess. Okay. So just some pointers. All right, then another type of fundamental news that we can use would be the market buzz. And then we'll get into looking at gold. I have a plan for gold for what's happening tomorrow. So if we go to the market buzz, we can look up any instrument, okay? And sometimes there's news that's actionable in your mind, and sometimes the articles don't convince you. It's okay. So the larger bubbles are trending the most, meaning there's the most buzz online about them. We found the most articles and links to read about what's happening with those companies. The smaller ones have less. You know, there's not much about Ford Motor Company right now. 20 mentions, 20 article links. Microsoft, 555. Tesla, 525. And you might draw a conclusion that these probably are trending more on the charts then too, if there's so much interest online about them, okay? Bank of America, or this is Boeing, etc. Google, okay? You can also switch categories. We could look at the commodities. What's trending the most? Okay, there's gold. What's happening about gold? We can take a look. And what's nice is it'll also give you a technical breakdown in the market buzz. So it's like a signal, like our signals that come, our technical signals, but built into the market buzz. So price may rise 4.9%. That's the expectation right now. This is coming from professional analysts at Trading Central. They think in the coming hours and days, gold may go up near 5%. If you want to see their technical analysis reasoning, click on the trend analysis. It loads it over here. It shows you the support levels below. If it breaks below the blue line, they say, okay, maybe you have your stop loss there, you get out. As long as it's above this blue line, they're saying they think it will continue to rise up towards these green lines up here, which are the resistance levels that they suggest maybe to take profit. So the expectation is gold could head up towards 2100 plus, all the way towards 2155. Okay, that's quite a prediction. 5% almost rise in gold. Okay, so then you can start reading articles to see, does the news support that? Okay, Fed and regional bank stress adds to dollar's appeal. Okay, that kind of works maybe against the idea of gold going up if the stress on regional banks right now is adding to the appeal of the US dollar. Doesn't say adding to the appeal of gold. It says adding to the appeal of the US dollar. And so you can read through these articles. You click on them. It gives a synopsis. If you don't learn enough from the summary, you can read the whole article. And there it is. If you want to understand what do they mean by that headline, then you can read the whole article. Fed and regional bank stress add to dollar's appeal. You can read the whole article. Okay, so you've got the news easy to find with these tools, and you can read through and see what that means to you. Okay, let's go ahead and let's look at gold. Since Trading Central's prediction there is expected up to 4.9% rise. Okay, so let's look at gold. Even though that first article we clicked on maybe works against that idea, it was only one article. But let's assume you read a few articles and also you see that analysis from Trading Central of an expected 5% rise, and you say, okay, if I like the entry point, maybe I'll buy on gold, okay, based on what you read and what you saw with that signal. So let's bring up gold then. Let's look at the gold chart. Is the entry price nice right now to buy? Well, it did just push down to a support level that I drew earlier in the week. By the way, we had a successful trade from Tuesday evening's webinar. We saw that this was ranging leading up to the interest rate announcement, that it was going up and down between these price levels. So we sold from the high point, had pending orders to sell from the high point and buy from the low point in this ranging pattern leading up to yesterday's announcement. And it did indeed bounce from the low point. We're able to hit, I believe it was let's see, let's look at the history. We're able to hit on the Here, gold buy. So the pending order buy kicked in, or we even did actually, I think it was in the right spot. We did a market move. Yes, we did a market move because it was protected by AvaProtect. So the protection cost 1% or so of the account, and the profit came in over 2% of the account balance. So overall, we did a protected trade that the overall profit was, I don't know, 800 or 900 when you subtract out the cost of the protection. Okay, so we can look at a similar type move now surrounding the non-farm payroll announcement. The same idea. Yeah, I don't know if there'll be a Valentine's Day rally. Mike is suggesting that, maybe. So we're looking here at gold. If I can bring the gold chart back up, it left me. Now we're looking at gold at the past movements here ranging. It looks like it wants to break out of this range, but it hasn't chosen a direction. Okay, but if the signal just told us gold should rise 5%, and that signal coming from some professional analysts at Trading Central, we hope they know a little something. They're not always right, by the way. If they were, then I would just trade those signals all day long and I wouldn't have to do anything else. But if you analyze their signals and you agree with the technical analysis that they took the time to outline for you, and then you think the fundamentals might be on your side, then it makes sense maybe to do the move. Okay, so we just saw a statistical advantage that the euro, if those jobs numbers come in weaker than expected tomorrow out of the US, that the euro tends to rise against the USD with a weakening USD. Well, then it makes sense that gold maybe could rise against the USD as well if the USD weakens with lower than expected jobs numbers. So if you think, hey, I'll take a shot that those jobs numbers could come in worse than expected. If they don't, I'll protect with AvaProtect. But if they do come in worse than expected, I'll already be trading in the direction that the signal said I should trade. So, and the statistics from the past in the economic calendar show the USD tends to weaken if indeed they do come in below expectation. If they come in above expectation, you got a 50-50 chance, right? Half the time it went up, half the time it went down. So if you add that all together, it looks like a better percent chance that the USD will weaken with tomorrow's announcement rather than strengthen. Okay, because when it comes in, when those numbers tomorrow come in lower than expected, it was a 75% chance USD would weaken against the euro. If they come in higher than expected, it was 50-50. So overall, that's still, if you add it all together, a statistical advantage with that announcement that maybe you'll get a rise on things against the USD. So gold being paired against the USD kind of works in that direction, fundamentally speaking. Then we see a support level, technically speaking, backed up by a signal from Trading Central that also says they expect a 5% rise. So now I've got a working strategy here. It's not one tool that I'm using. It's not just the signal. It's not just the support level. It's also the fundamental news and other reasons. And so when you add that all together, if you're at least, I don't know, 80% certain that maybe you should make the move, then you make the move, right? If 4 out of 5 things are aligned the way you'd want it, or 3 out of 4 things aligned the way you want it. And I think it is with gold. Okay, so, and on top of it, we've got an opportunistic entry point here, just above the support level. Okay, so now we have a couple options if indeed you wanted to buy. You could put a stop loss just below this support level and say, okay, if it goes down, that's it. Okay, that's easy to measure my risk then. So stop loss just below the support level would mean I could put a stop loss for a short-term move, I don't know, down at 225, 226. Okay, so if I put my stop loss here at 226, okay, I'm below the support level. It has to break the support to hit my stop loss. Okay, I could put it lower, below another support level to try and be on the safe side. So it would have to break this support, which is an area where it hit and went up, hit and went up, hit and went up, and again hit and went up. So that's an area of support. The price on gold's having trouble going below there, right around 229, 230. I might even get below another support level where it had trouble breaking below and put my stop loss down there. So if it does temporarily break this one and go back up, I'm still in on the trade. It would have to be a more significant drop for me to give up on the move. So 224.50. All right. I think that's a fair spot. If indeed I think it'll go up, I could give myself to 224.50 before I would give up. All right. Take profit. Maybe I think it could go up to this high that it was at not that long ago. Okay? It was this week. It was here. Indeed, actually, I think yesterday it was up here. Okay? Above 250. 255. Okay? So let's say my take profit's 255. I don't even need it to break yesterday's high to hit my take profit. That's all the momentum I would need is just to test that high without breaking it. Look at the advantage. Potential profit, 10,500. Risk, less than 3,200. Okay? With this type of move, I only need to be right once out of, what, 3 times? Once out of 4 times. And I profit, or I break even. Okay, approximately break even, small profit, 1 out of 4. If I'm right, even 50% of the time, 40% of the time, 1 out of 3, I make a nice profit on this. Okay? So this could be a move that would make sense from a market standpoint, just to take a buy, support level from a technical perspective. Maybe the fundamentals are working for you here too, and you click buy on a market move. Okay? With a measured risk. That's it. So I'm in. I'm risking 3,000. Now, maybe I didn't want to risk 3,000 though, to go after 10,000. I like the ratio, but maybe I didn't want to risk, 4%, 5% of my balance. So what I could have done was adjust the stop loss. So it's at a level that makes more sense for me. So let me just scalp that profit. Okay, I just took $67 profit because it's bouncing off the support level, right? Now let me re-show you though how I could risk manage that better. So why was it easy to pull a short profit on that? It's simply because there's a nice support level we see it's already trying to bounce off of. Okay, and you see it pushing up. But if I wanted to buy that same setup, okay, take profit 20.55, we said. Stop loss was down at 20.24.50. 20.24.50. Okay, so there's the 10,000 plus potential profit, 3,300 or so risk. But if I only want to risk, let's say 600 per trade, around 1% of my balance. So now I just need to adjust the trade size. The technical analysis showed me how I want to set it up. The fundamental analysis told me the direction I want. The technical analysis then shows me the exact spot for my stop loss and take profit. And now I just adjust the trade size until I have the risk reward that I'm comfortable with. So 0.9 puts me at almost 1%, 0.75. Okay, under 1% risk, okay, less than 600. And my potential profit's over 1,700. Same ratio as before, but smaller risk reward. So now I go ahead and buy with a better risk managed trade that in terms of the risk management I might lean towards, not wanting to risk 3,000 on this type of balance, which is quite a percent risk per trade. I would rather risk maybe around 1% or a little less, but that's up to each trader. You can stick with the larger risk, smaller risk, as long as you understand what the risk is. And that's what this order window can help you do. Okay, so that's one strategy. Small risk, less than 1% on this move, and putting a stop loss. If it hits a stop loss, I'm out. That's more of a move that I'm hoping comes to fruition before tomorrow's announcement. I think it could hold because it's ranging. It's ranging between this price level here and this level here. Ranging means moving up and down between those two prices over and over, like it's waiting on big news. Well, the big news is tomorrow, maybe. So maybe this continues to range and I can hit a profit before it even gets to the announcement tomorrow. Now, let me diversify my strategy on gold. What if it does go down and hit my stop loss and then go up? Well, then I took the loss even before the announcement came tomorrow. Okay, so I'm also then going to make a move with AvaProtect. I'm going to say I'm willing to pay for the protection the same amount I'm willing to risk per trade, like I did on Thursday's session that paid out $1,500 almost on the payout. The protection cost 1% of my balance, which was about 600. Okay, so I could do that same type of setup. So if I want to protect through tomorrow's announcement, and you know what, I'm going to give myself all the way through the weekend. So I'm going to do 2 days protection. That takes me, the protection then goes 2 business days. So from today to tomorrow is 1, and from Friday to Monday is 2 business days. I'm protected all the way to the 5th on this move, which means I don't need a stop loss yet. So if it does go down where my stop loss would have been, I don't care. It won't close my trade because I have protection. I didn't put a stop loss. And then I can be more patient, not worry about larger loss, because if it keeps dropping, I'm protected. I get the payment back from the protection. Any dropping that goes, any negative movement that goes during my protected time period gets paid back. So I can be patient to see if after the announcement, it comes flying up Friday and into Monday. Okay, so a different strategy, a more patient strategy by paying for protection. So the negative is I have to pay the protection up front. So 2 days protection costs $4,600. So I want a smaller trade, right? So let me go 0.5. Okay, so only 518 for 0.5. What about 0.6? About 1% of my balance, right? 621 cost. My balance is over 63,500. So it's under 1% of my balance cost to go after how much profit? Let's see. Remember, our take profit was at 2055, which is this high point up here from this week. Okay, I can make up to 1380, risking 621. And that's basically what the move Thursday I showed you turned out. It was a little higher than that 1400 something it paid out, and we paid up front about 600 something for the protection. Now, what we can do since this protection goes to Monday is say, you know what, why am I looking at 30-minute candles? Maybe I want a higher potential profit. If you remember in that signal, the prediction was gold could go up as high as 2150, 2152, something like that. So maybe we look at a higher on the 1 day candles. We see not that long ago it was up here, above 2100. Okay, so you could start to say, okay, it is possible that by Monday it could break yesterday's high, certainly. And so with this type of protected move where I'm protected until the 5th, I'll give it a little more distance that maybe I think it could go back towards 2140, something like that, which is more in line with the signal we saw in gold. They said it could go up to 5%, 4.9%. So now my potential profit is over 10 times the cost of the protection. And I can obviously close it early. If I look Monday before the protection is going to end and it's up a couple thousand or something, I can manually close it if I'm afraid it'll go back down. Okay, but I'm giving myself a chance. That signal said it could go up near 2150. So why not put it just below that, 2140, and give myself a chance on that? Okay, so I'm trading on gold twice with 2 different strategies on the same instrument. One is using the benefit of AvaProtect, so I can be patient and not have to put a stop loss yet. And the other is a more basic strategy where I found a support level or 2 and put my stop loss just below those, hoping it'll hold and go up. Okay, so a couple different ideas there with trading on gold with a couple different risk management strategies, using the fundamental news that's coming as our hopeful impetus to push gold largely in hopefully our direction. But if it goes the wrong way, it's a very small risk with a much better potential profit if it goes the right way with the big fundamental news that's coming. All right, any last questions, comments before we end things? Okay, great. Thank you all for attending. I hope you make some successful moves. They don't have to be the same as my moves, by the way. But hopefully the tools that I'm showing you, you can make use of to form strategies like I'm showing that suit your preferences, obviously, to make some informed moves using the fundamental news from the past and present to help you hopefully raise your P&L at the end of each day, end of each week, etc. All right, everybody, bye for now. Good luck with your trading.